On Friday, this past week, the United Kingdom's Office for National Statistics released the latest reports on the UK's gross domestic product, a means of measuring economic output. It was revealed that their economy grew by negative 0.6% month over month and by negative 0.1% quarter over quarter, which entails a contraction for both timelines. Although these numbers are less disastrous than had been forecast, they are unfortunately part of a trend. New Zealand has also suffered a contraction in GDP, while the United States has experienced 2 consecutive quarters of contraction, a technical recession. While these declines in output are historically strange, seemingly contradicting recent phenomena like relatively high levels of employment and stock market rallies, they ought to be taken into account by traders nonetheless. Let's explore some of the root causes to these contradictions, as well as factors exacerbating them as we discuss why global recession is still likely. Number 1, restricted supply. Often when inflation occurs, it's because demand for a product or service is rising at a faster rate than the supply of the product or service itself. However, this is not always the case. Sometimes inflation is caused primarily by a decrease in supply of a thing rather than growing demand alone. We are experiencing this phenomenon today with high food and energy prices, which explains why CPI has far outpaced core CPI. Because commodities like oil and commodity crops are scarce resources that consumers rely on to live, geopolitical problems like the invasion of Ukraine and resulting sanctions, as well as environmental problems such as heat waves, droughts, and famines, restrict available supply. Many of these problems either are or can be chronic and near ubiquitous, leading to persistent inflation from shortages that cannot be resolved through contradictory monetary policy.
Here's a free Discord channel every Forex trader should join. You get access to daily trade ideas, market scans, and market coverage for what's happening in the Forex world today. See what professional traders are thinking on things like GBP JPY, gold, and Euro USD. And the best part, it's totally free. Click the link on this video and it will take you to a Telegram chat with one of our team members. Send them the word apply and we'll get you in the free Discord shortly after.
Number 2, interest rate hikes. While interest rate hikes are a crucial monetary policy tool for curbing inflation and cooling an overheated economy, they also come with a nasty side effect: slower growth. This is because rising interest rates are designed to stifle growth by limiting consumers' and businesses' ability and desire to borrow money, restricting spending and thus the chances of inflation. While lower GDP growth, even a contraction, does not necessarily create a recession, it is nonetheless playing with fire by taking steps in that direction. This is especially relevant considering that many central banks such as the Federal Reserve and the Bank of Canada have begun fully embracing hawkishness through unusually aggressive rate hikes. Number 3, trade deficits. Another economic factor that often quite literally detracts from a country's GDP is trade balance. Some wealthy countries have negative trade balances or trade deficits created by their imports exceeding their exports. While a trade deficit might grant consumers more access to lower priced goods from other countries, it also results in a net loss of economic output that is subtracted from GDP. When trade deficits are frequent, as in the case of the US, this can theoretically severely impede economic growth, which likely contributed to the country's technical recession. Both the UK and New Zealand have recently been reporting trade deficits as well, which is unsurprising. Number 4, underfunded pensions. Underfunded pension programs are proving to be a difficult problem to contend with. With large percentages of many countries' workforces retiring, public pension systems such as Germany are struggling to keep up, with the German government bailing out the program with 100 billion euros in 2021. Likewise, Social Security in the US is expected to be trillions of dollars behind in long-term funding, despite an average annual benefit amounting to less than $20,000 per recipient. Failure to improve pensions severely limits demand for growth within an economy, since a large chunk of the country's populations are retired adults who still spend. Number 5, real pay cuts. Some economists worry about the possibility of high inflation combined with hot labor markets, creating a wage price spiral, where inflation persists uncontrollably due to rising employee earnings. However, the truth appears to be less fanciful and grimmer. Even with today's historically high rates of increasing incomes for working people, year-over-year inflation completely negates these raises in most circumstances. For example, With average hourly earnings increasing over 5% in the US, when we account for 8.5% year-over-year CPI, this implies a real pay cut of approximately 3% for working people. This entails a net loss on consumer spending, which means less revenue for businesses and thus lower GDP growth. Number 6, self-fulfilling prophecy. For better or worse, market sentiment has a hand in creating fundamentals by allocating capital, not just the other way around. Thus, if dread about a global recession continues to loom in public consciousness, traders and investors may respond by buying and selling accordingly, potentially accelerating a coming recession with stock market and forex sell-offs. In this way, the general perception of an impending global recession alone can play a large role in creating one. Consequences for pairs? Lately, much of traders' fundamental analysis has focused on how central banks respond to inflation as the primary economic threat. However, if global recession becomes a reality, there is a chance we could see central banks return to their dovish ways, which may warrant reassessing pair biases from scratch. It is also worth noting that these hypothetical dovish pivots may not occur in the face of stagflation, which unfortunately seems possible given supply concerns.